Hey everyone, welcome to The Explainer. Today we're unpacking something absolutely huge, a concept that can literally transform your entire financial future. We're going to decode the core philosophy of one of history's most successful investors, Ray Dalio, and look at the exact mechanics he used to build an absolute empire.
So let's kick things off with a pretty big question. It's one that completely challenges how we naturally think about the stock market. What is the single biggest mistake most investors make? Now, if you're like most folks, you probably assume it's picking the wrong company, right? Or maybe buying in at the wrong time. But according to Dalio's principles, the real trap is actually far more structural than that.
Here is our roadmap for today. We'll be covering the investing trap, the Holy Grail revealed, the math of risk, balancing beta and alpha, and finally, how to systematize your strategy.
Okay, let's get right into part one, the investing trap, specifically the flaw in chasing the so-called best stock. There is just this stark contrast between how amateurs and professionals operate. The common mindset is all about hoping to get lucky. Scouring the market, finding that absolute best company, and going all in. But when you do that, you're betting entirely on your own ability to predict the future. The billionaire mindset? It's completely different. It's not about finding one golden goose. It's about finding 10 to 15 good, uncorrelated investments. Because concentrating your capital in just a few holdings exposes you to a massive single point of failure. True professionals actually engineer their portfolios to withstand sudden shocks by distributing that risk.
And here is the structural issue that's just hiding in plain sight. The average stock is actually 60% correlated with other average stocks. So what does that actually mean for you? Well, it means if you buy a tech stock, a car company, and a retail stock, you might think, great, I'm diversified. But if the overall market takes a hit, they're probably all going to drop together because of that 60% underlying correlation. Your eggs might be in different baskets, but all those baskets are sitting on the exact same fragile table.
Honestly, traditional diversification through just owning more stocks is kind of an absolute myth. Ray Dalio puts it perfectly. He says, you can put in 1,000 stocks and you are not going to materially reduce your risk. If you own 1,000 things that all move in the exact same direction when a recession hits, you haven't protected yourself at all. When major macroeconomic events strike, like an interest rate hike or a supply chain crisis, they hit the entire stock market simultaneously. You've really just spread your vulnerability across a wider spreadsheet instead of actually reducing your danger.
Which brings us to part two, the Holy Grail revealed. Let's look at unlocking the power of uncorrelated streams.
Look, if you take away just one core concept from this entire explainer, it should be this. You need a relentless pursuit of 15 return streams that do not move in the same direction at the same time. Dalio literally calls this the Holy Grail of investing. Uncorrelated simply means that when asset A zigs, asset B zags. Or maybe asset B just sits perfectly still. They react completely differently to inflation, growth, and varying economic environments.
The underlying math here is basically magic. If you have just one stream, you're absorbing 100% of the baseline risk. But find 5 genuinely uncorrelated streams, you've already cut your risk in half without sacrificing your overall returns. And if you can actually get to 15 streams, you drop your risk by nearly 80%. That improves your return-to-risk ratio by a massive factor of 5. You've engineered a portfolio where a massive shock to one asset class barely leaves a dent in your overall wealth.
All right, part three, the math of risk. Let's really understand these return streams so you can put this into practice.
So think of your beta as the broad foundation of your portfolio. It moves naturally with the macroeconomic environment rather than relying on outsmarting others. A perfect, concrete example of a beta stream is just holding a broad index fund. You aren't picking specific corporate winners, you're simply letting that asset drift upward as the general world economy grows over time. If inflation shifts or productivity rises, your beta assets react predictably based on their intrinsic nature. You aren't trying to beat the market here, you're just strategically riding the environmental waves.
Conversely, your alpha is the aggressive, highly competitive slice of your investments. This is where you are actively trying to beat the market. And as Dalio notes, alpha is a pure zero-sum game. For you to generate an outsized return, for you to actually produce alpha, you literally have to take that money away from another investor making the opposite bet. It's exactly like sitting at a high-stakes poker table. Every single dollar you win is directly extracted from the person sitting across from you.
Moving to part 4, balancing beta and alpha. And we're going to look at why dollar matching totally fails.
You see, splitting your money 50-50 between stocks and bonds is actually deeply flawed. Why? Because it completely ignores the underlying turbulence of those assets. Most investors think, hey, I have 10 grand, I'll put 5 grand in stocks, 5 grand in bonds, and boom, I'm perfectly balanced.
But Dalio argues you aren't balancing risk at all here, you're just balancing dollars. Because here's the thing, stocks are roughly twice as wild as bonds. So a 50-50 dollar split means your actual risk is still heavily dominated by the stock market. If stocks take a sudden nosedive, your perfectly matched dollar amount in bonds simply won't budge enough to save your portfolio. To achieve true equilibrium, you have to allocate your capital so that the risk is equalized. This usually means you have to hold a substantially larger dollar amount of your safer, less volatile assets just to effectively offset the wild swings of your aggressive ones.
Let's bring it all home with Part 5, Systematize Your Strategy. This is where we turn all this theory into an actionable playbook. By meticulously following these steps, you transition from just gambling on a single outcome to engineering a resilient, all-weather financial machine. First, lay down that broad, environmentally driven beta foundation. Second, layer in multiple uncorrelated alpha bets. Third, balance them based on their actual volatility, remember, not just their dollar value. And finally, step 4, write down your universally applied rules.
Dalio strongly stresses that by writing down your investment criteria and rigorously testing them across all time periods, you remove the emotional panic from investing entirely. He actually learned this the hard way after a massive, painful loss in 1982. He almost went entirely broke because he relied on his own human opinion rather than tested mathematical systems. By turning your strategies into algorithms, rules that apply whether it's 1980, 2008, or today, you protect your portfolio from your absolute worst enemy, your own emotions.
To quickly summarize the core thesis of our explainer today, these 4 foundational pillars are what ultimately stand between a highly vulnerable portfolio and true financial stability. Avoid putting all your capital into a few highly correlated stocks. Relentlessly seek out those 15 uncorrelated return streams so you can slash that downside risk by 80%. Balance your assets by their mathematical volatility, and definitely systematize your entire approach. I'll leave you with this provocative final thought to evaluate your own portfolio. Ask yourself, do your investments rely on you being perfectly right about the future, or are they engineered to be balanced no matter what happens? Because if your strategy depends on you never making a mistake, you're walking a tightrope without a net. I highly encourage you to explore the math of risk balancing even deeper.